This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Accounting for labour. There are really three sections to this chapter. The first is section 2, talking about direct and indirect labour. And you remember from the previous chapter, direct labour are those workers who are actually involved in producing goods. Indirect labour don't actually produce anything. Well, indirect workers, indirect employees, is always an indirect cost, an overhead. So it's things like supervisors. You know, we've got supervisors in the factory supervising the workers. They are a cost in the factory, they are a production cost, but the supervisors don't actually produce anything themselves. And so they're an indirect cost or an overhead. On the other hand, direct costs, and this is the bit to learn, if the workers are directly involved in making products, direct labour, then it's going to be a direct cost provided we're either talking about their basic pay. So, you know, if we pay the workers $5 an hour, fine, that is a direct cost, plus any overtime premium if at the specific request of a customer. Now, I'll say a bit more about it, overtime premium, later, but what it is, you see, normally we might pay workers $5 an hour. If they work overtime, if they work extra hours to what they normally expected to, we like to pay them more. Maybe we might pay them $7 an hour. Well, the extra $2 we're paying them is the overtime premium. And that's treated as a direct cost, but only if it's at the specific request of a customer. Now, these direct workers, we may pay them money for other reasons, but any other payment to them is an indirect cost. So look at the next line, general overtime premiums. Our workers may be working overtime, but not because any particular customers require it, just because I haven't got enough workers or something. Well, their basic pay is a direct cost, but any extra for overtime is treated as an indirect cost. Bonus payments, we might give them bonuses for some reason, it's an indirect cost. Idle time is when you're paying your workers during hours when they're not working. For instance, maybe a machine's broken down, and while we're waiting for it to be repaired, the workers can't do anything, but we're still paying them. Well, the payment while they're not working is an indirect cost. Sick pay, well, again, if we're paying them when they're off sick, so again, they're not working, it's an indirect cost. So it's only a direct cost if, as I've said, it's their basic pay, $5 an hour or whatever it is, or any extra for overtime, any overtime premium, provided it's at the specific request of a customer. Okay, the next section talks about remuneration methods. Remuneration, another word for pay, how we go about paying them. And there are two basic ways you like to come across. One, the more likely one, is what we call time work, where they're paid per hour. And look at the example there. For example, if an employee is paid at the rate of $5 an hour and works for 8 hours a day, the total pay will be $40. So they paid a rate per hour. They usually or often paid extra if they work overtime. I mentioned before, if they normally work an 8-hour day, but you have them work 10 hours, then the extra 2 hours they're normally paid at a higher rate. Look at the example again. For example, an employee is paid a normal rate of $5 an hour and works 4 hours overtime, for which he's paid at time and a half. So those 4 hours, if it wasn't overtime, we'd be paying them 4 hours at $5, you'd be paying them 20. However, because it's overtime, we've agreed to pay them a higher rate. And it says they'll be paid at time and a half. Well, what that means is, for every 4 hours, well, here they work 4 hours, the pay we'll give them is if they'd worked for time and a half, 1.5 times as many hours. So if you work 4 hours overtime, we'll pay them as though they'd worked 6 hours. The rate is $5 an hour, so they'll actually get 30. So time and a half, they paid half as much again. Time and a quarter, they'll be paid a quarter as much again, and so on. Now, one thing to be careful of, that's what they'll actually be paid, the $30. However, their basic pay, if it wasn't overtime, would have been 4 hours at $5, would have been 20. So the basic pay would have been 20. We're paying them 30 because it's overtime. Well, the extra 10 is the overtime premium. And think back to as I was saying earlier, their basic pay is a direct cost. The premium, the extra 10 they were paid, is treated as an indirect cost, unless it was at the specific request of a customer. Anyway, that's time work. The other standard way you might come across is piecework. Oops. Where instead of being paid an hourly rate, regardless of how much or how little they're producing, with piecework, they're paid on the basis of what they produce. So look at the example. For example, an employee is paid 20 cents for every unit produced with a guaranteed minimum of $7.50 a week. In week 1, they produced 5,000 units. Well, fine. We're paying them at the rate of 20 cents a unit. They'll be paid 1,000. We have guaranteed that they'll be paid a minimum of $7.50. Well, 1,000's more. So that's how much they'll be paid. In example 2, in week 2, they produced 3,000 units. Well, at 20 cents a unit, that means they're paid 600. And if there was no minimum wage guaranteed, that's how much they'd get. However, this example, it says they've got a guaranteed minimum of $7.50. Week 1 was irrelevant. 1,000 was more than $7.50, but they've got to be paid at least $7.50. So in week 2, they'll be paid this guaranteed minimum. Over the page, as mentioned, bonus schemes. Companies may offer incentives, offer to pay people extra depending on how well they achieve targets. Well, I'll come to that later, but there's no rule. It's up to the company to decide if you're going to pay bonuses, but we'll come to that in a later chapter. Finally, the last section you'll see mentions various labour ratios that you could be tested on. And although I've written all the ratios down there, I will, for all of them in fact, I'll make up a quick example. But these, it's just learning the ratios and being aware of what they are. First of all, idle time ratio. I did say earlier that idle time is time when you're paying them, but they're not actually working. I'd say an example I gave earlier. A machine breaks down. Maybe it breaks down for 10 hours. They can't do any work. We're having to pay them. Well, it's idle time. And of course, a company wants to keep that as small as possible. You don't want to be paying people when they're not actually doing anything. Well, the ratio, I hardly need an example, but I will. It says it's the idle hours divided by the total hours. So just suppose I told you this week we paid for 1,000 hours work, but 50 of the hours were idle. So they only actually worked 950, but we had to pay them for 1,000. Well, the idle time ratio, 50 hours idle out of a total of 1,000, as a percent is 5%. So I think that's an easy one if you've understood what I mean by idle time. The next one, labour turnover ratio. This is looking to see how many employees are leaving. Any business, most businesses anyway, would prefer that employees continue to work. We don't want people leaving and then having to bring in a new person to take over, because the new person will need training. It'll be a while before they're as good as the person who left. Obviously, some people will leave perhaps because we need fewer staff. That's different. If we don't need as many, we get rid of a few. What we're looking at is people leaving and then us having to replace them with somebody new. And you'll see the labour turnover ratio. It's the number of workers that we actually replace, workers replaced, as a percentage of the average number of workers or employees. And let me give you an example to make sure you're clear what it is we're talking about. Suppose I tell you at the start of the year, we had 100 employees. At the end of the year, we only had 70 employees. We didn't need as many people. Obviously, all companies, forget replacing for the minute, all companies may one year need to increase the number of workers, other years they may need to reduce. Well, fine, we had 100 beginning, 70 at the end. And suppose I tell you that during the year, 40 had left. Well, the turnover ratio is we're looking at how many workers were actually replaced. People who left, but we then had to hire new people. And think about this, at the start of the year there were 100. 40 left. And so you'd expect at the end of the year there to be 100 minus 40, 60. If 40 left and we hadn't bothered replacing anybody, we'd have 60 left at the end. But we've got 70. How have we got 70? It must mean that of those 40 who left, we replaced. Well, we end up with 70. It should only have been 60. We replaced 10 employees. If we had only 60 left at the end, we haven't replaced any of them. But since we've 70 left at the end, we must have replaced 10 of them. And so the ratio, the number replaced is 10. Oh, sorry, before I put the ratio, what's the average number of employees? Well, it was 100 at the beginning and 70 at the end. So the average 100 plus 70 over 2 is what, 85? And so the ratio now should be no problem. We replaced 10. The average number over the year is 85. And so as a percentage, 10 over 85, 11.8%. And again, companies normally would want to keep that as low as they could. You know, okay, some leave because we tell them to leave. We need fewer people. But we'd rather keep the number to a minimum of those who leave, but we don't want them to leave. We need to replace. All right, the next three are related. First of all, the labour efficiency ratio, as you'll see, is measuring how fast workers are working. You've got the ratio there. It says the expected hours to make the output over the actual hours taken, but to make sense of it, let me write up an example, and in fact I'll use the same figures for each of these next three ratios, which you'll see are related. Suppose I tell you we budgeted on producing 50,000 units and taking 20,000 hours. So that's what should happen. We should take 20,000 hours to produce 50,000 units. We actually produced 65,000 units and took 22,000 hours. Now we want to know, first of all, for efficiency, were they working faster or slower than we were expecting? Well, on the budget figure, 20,000 hours for 50,000 units, the standard or budgeted time per unit if it's 20,000 hours to make 50,000 units, we should be taking 0.4 hours. Every unit should take 0.4 hours to make. They produced 65,000 units. And so the expected time (65,000 units) should have taken 0.4 hours each, which is 26,000 hours. So that's how long we expected them to take. How long did they actually take? They only took 22,000 hours. And so they've worked faster than we were expecting. They've been more efficient. It's good. And so the efficiency ratio, I'm not going to write the formula down, you've got it printed in front of you. But the expected hours for our production, 26,000, divided by the actual hours they took, only 22,000, which is a percentage, is 118.2%. And it's good. The higher that is, think about it, the higher that is, the faster they're actually managing to work, the more efficient they are. So that's efficiency. The next ratio is capacity. And that's looking to see, did we get more or less hours than we actually expected? You see here, we budgeted on how many hours? We budgeted on 20,000 hours. That's how many hours of work we thought we could get. Now, capacity is saying, did we manage to get more hours than we thought or fewer? Well, here, the actual hours. How many hours work did we get? I've lost it. 22,000. I don't know. Maybe we managed to get some more workers or something. But we managed to get more hours than we were actually expecting to get. And that's what capacity measures. The capacity ratio is the actual hours they worked, 22,000, over the budgeted hours of 20, which again as a percentage, I can do that in my head, is 110%. And so the higher that is above 100%, the more hours we've managed to get. If that's below 100%, it means for whatever reason, we got fewer hours of work than we were actually hoping for. Now, those two effectively we can put together. Now, think about this. We budgeted on producing 50,000 units. How are you going to manage to produce more? There are two ways of producing more. One would be to get more labour. If we can get more labour, we should be able to make more units. The other way, though, even if we couldn't get more labour, the other way of being able to produce more is if they work faster. Well, activity effectively puts the two together. So the production volume ratio, or the activity ratio, it's the expected hours to make our output. Ooh, we work that out. The expected hours to make the output was 26,000. For the units we produced, we'd expect to need 26,000. Divided by the budgeted hours. The budgeted hours were 20,000. And what does that mean? It's 130% there. It means we managed to get 26 hours worth of work. They produced so many units, it was worth 26,000 hours of work. And how did we manage to get that many hours of work? Partly because we managed to get more labour than we expected, that was the capacity, and partly because they produced a lot faster, they produced more units than we'd expect. And in fact, that is equal to the efficiency ratio times the capacity ratio. What were the efficiency ratio was 118.2. So we were getting more hours of work from our workers anyway. The capacity ratio was 110%. So we had more labour than we expected. And in both ways, we can effectively produce more. And what does that come to? $15,000. Something's gone wrong with my calculator on my fingers. It comes to 130%. So I don't know, arithmetically, I think each of those is easy enough, but do go through them and learn them and practice them. You know, have a go at the online tests as usual. And do remember, the production volume or the activity ratio will be equal always to the efficiency times the capacity.